to the Capital Mindset Show. Today's going to be another subscriber request, and this time it's going to be perhaps some of you's most favorite brokerage platform, and that's Robinhood. Now, a little bit about Robinhood. Robinhood came very strong into the game as the more affordable brokerage option with zero commission trades. I'm sure most of you know. Unfortunately, they do not have, at the moment, or the present moment, a large presence in stuff that are tax advantaged. So we'll discuss a little bit about Robinhood. So they've IPO'd recently, and we all know or are somewhat familiar with their product. A long time ago, had a account with them, but I no longer do. Okay, and there are mainly some reasons for that, but nothing terrible with the product. Actually, I'll just say this right now: their UI is perhaps the best in their class. Right? It's separate from everyone. It's so good. It's so easy to use. And that may be a good or bad thing, depending on how you look at it. I understand some people may view that as a bad thing because it gamifies the investing game. And I just said the word investing game because that's basically how some of people can view it. And that can be a negative. So Charlie Munger, for example, he has very negative views on Robinhood. He thinks it's the worst thing to ever exist. That's kind of what he said along those lines. And we'll always begin again with the price action. Take a look at that. So for those of you who have seen the video uploaded today already, you guys know that I was discussing about what's going on right now, deleveraging, et cetera. Robinhood is one of those assets. Remember that retail investors, the stocks or companies that are heavily flooded with retail investors tend to be the ones that get hit the hardest when such a thing occurs, when a bubble pops. So we're going to be seeing some good deals, by the way. This is the time not to panic. This is the time to build your watch list. I don't know what other way I can say it, but do not panic, sell if for the right reasons, not for the wrong reasons. So looking at this company, it's no surprise it has fallen quite drastically. And we'll take a look at the model, how overvalued this was. This was incredible. And again, the hype YouTubers were kind of talking about this company around there. And now it's fallen about 82%. Okay, so is it a deal now? We will find out, or I will give you my personal opinion on that. So first, let's take a look at their presentation, get a feel for what this business does, what they stand for. This is the sales pitch. If we don't like what we see here, we probably won't like what we see under the hood, pun intended. All right, so crypto, cool. They're doing crypto exchange. Great. IPOs, okay, cool. They're adding all these features. So they're basically expanding. I see them going into the future, expanding into kind of some sort of wallet, competing with Cash App, stuff like that. Good on them. All right. So net cumulative funded accounts. Okay, cool. We want to see this number growing up. This is going to be very important. It's slightly down. This is kind of indicative of the momentum slowing down for this business. This is bad. This starts to get negative monthly active users. As the market goes into a downturn, this is going to exacerbate. All right. So you guys are seeing what's going on right now. Well, this is where you really see the paper hands, all the retail investors talking smack online about paper hands. This is where you really see it. All right. And then right here as well, you're going to see the same kind of thing. So assets under custody, this is going to be coming down, especially if we go into market downturn. People are going to be selling out. People are going to start thinking the stock market's gambling, yada, yada, yada. History repeating itself yet again. All right, average revenue per user. This is going to be coming down if everything else starts to scale down. All right, I'm painting a picture here, but you guys should kind of see what I'm trying to talk about. Things are not looking good right now. All right, but that's sometimes the time to invest. All right, but we'll look at the proposition. So total net revenues, this is going to be coming down as well. Yeah, no surprise. Yeah, all this is not looking too good. This is pretty much why they're crashing. If I had to guess, this is why they're crashing, or one of the reasons why they're crashing really hard. So operating expenses are rising. Okay, general and administrative. Yeah, what are you guys doing? Oh yeah, that's right. They're actually offering customer service now. Technology and development, brokerage transactions, marketing operations. Okay, cool. All that stuff is fine. All right, general administrative, a lot of expenses there. All right, let's take a look at that. Net income should be going, in the wrong direction. You could say they're trying to grow as fast as possible, but they're not even growing. Adjusted EBITDA. Wow, even on EBITDA basis, you guys are, because it's probably operations causing that. All right, and we don't really care about all this stuff. We'll really talk about it later. So let's summarize what we kind of think about that. So I see that there's some turmoil. My concerns for them going forward is if there is market turmoil, What will that do for their growth in all the respective facets that we care about, users, assets under management, etc. On that note, let's actually go over to the model. And you see, we're kind of speed running through this, because it's not, we're only going to waste our time or use up our time and stuff that's important. So let's take a look. It's already put in the analyst right there, buy rating, ignore me, 192.2% upside by according to the analyst with a price target of 35.8. I already have him there a discount rate of 15% with a revenue growth rate compounded for 10 years of 15%. If you believe that right there, great. I averaged out the profitability metrics to be that of Charles Schwab. Yes, very aggressive. So keep that in mind. Please keep that in mind. Okay. From here on, just note the margins are quite aggressive. All right. All right. So no surprise. All right. So if I'm discounting at 15%, let's be a little less crazy about it. Okay. So if they achieve the margins at Charles Schwab, highly unlikely because they're kind of different, but let's say they do, 15% growth rate, they're a buy right now. All right. If you were trying to make 10%. All right. But here on this channel, that's market average. That's not good enough. 12%, still not good enough, especially because you're not getting really that much of a margin of safety. So 15% is the minimum, but something like this, definitely I would ask for a 20 because of the risks. Okay. It's not it hasn't proven itself yet. It's competing against giants. For example, the UI was not good enough for me to stay despite it being the best. It wasn't good enough reason for me to stay. I'm treated better elsewhere. I would go where I'm treated best, right? Where my capital is going to be treated best. So there's plenty of other brokerages that will be more than happy to treat me very nicely for putting my capital there. Robinhood didn't really treat me any better. Okay, so that's just how it is. And required rate of return at 20%. Let's see what growth rates we'd have to assume. Let's say 50%. All right, cool. If they can achieve 50%, outrageous, out of this world with the margins of around Charles Schwab, incredible, right? All right, so not realistic. Let's go to 40%. Probably also not realistic, just so you guys know, because again, we're assuming margins of Charles Schwab and 40% compounded. 30%. Okay, maybe because they're quote unquote growth company, but will they achieve those margins? Probably not. Okay, also dilution. I'm not even including dilution. Let's see what happens if I include a 2% dilution rate. See how much that drops? Even with these, right? I have to buy it at 13, right? So, we're at 12. All right. So and that's 30% growth rate again, with the margin Charles Schwab. All right. So let's say they dilute by 3%. It's that's a buyback, but let's say they dilute by 3% because of the lowest cost of capital. All right. That means it's not a buy right now. And they'd have to be growing at 30%. If they grow less than that, no deal whatsoever. Let's see what happens to kind of showcase. Well, let's see exactly what they need to grow at. What do we need to expect from them? Okay, about a 30, 32, 31, 31, 31% growth rate is what we'd have to assume in order to achieve something like this. Even we can then assume the dilution. Okay, so that's kind of fair. All right, but what are we assuming? The margin of Charles Schwab. So, not really good. Ignore this book value. People do not pay attention to a book value like that. Okay, that's going to be a lot of intangibles, stuff that's not really hard assets. A lot of people look at that book value and look at this price and be like, it's really close to book value, I'm going to buy. No, there's another company that was brought to my attention, Teladoc. Teladoc's trading below book value. Well, Teladoc bought the company that I was invested in called Livongo, and that's on there as goodwill. So that's on the balance sheet as an asset. Is that an asset? Not really. It's goodwill. Goodwill is an assumption. So be very careful with book values. Then there's something called tangible book values that I'll briefly mention that you guys should maybe look at that rather than just raw book value. Or you have to understand the nuances when you're looking at different companies and then look deeper and then kind of judge the book value for yourself and say, well, that book value is accurate. That book value is not so accurate. All right. So what I'm seeing here is, something that's not really too appealing at the current price. Things would have to come down drastically. Ignore some of this stuff. This stuff's because the new company, it's, kind of out of whack. So I'll discuss some of the stuff that's kind of important that sticks out. So operating margins are coming down drastically because, things are changing at the present moment. Things were really good during pandemic time, not so good now. Let's take a look out of here. This is not going to be good anyway, and this is, we don't care about that. So there's not much in the ratios per se. This is precisely why I would demand a really high rate of return or high discount rate. In fact, I think 20% is the minimum that I would command from this. And if I really wanted to be precise, I'd say about 25%. So at a 25% rate of return, I think it'd be quite fair, in my opinion, to invest in something like this that's highly speculative. This falls into the speculative bucket, right? If this were ever to make it into my portfolio, which I don't think it will, it would only make it into the speculative because it's full of potential, right? It has potential, but no execution and no proof that it can execute. This, for example, like Zillow is another company that's actually in the portfolio, but it's part of the speculative bucket. So meaning it's never going to make a large position in the portfolio, and it's restricted on how large it can ever become. Not that if it grows into a large position, that would be different. I don't punish the winners, but I cannot add raw capital. A certain amount of raw capital cannot go into it. And that's basically like a kind of an understanding that if something is just raw potential, you can't call it a core holding, core investment, because it's just potential, right? You're not discounting the cash flows and having a firm grasp on what it is those cash flows will be. You're kind of just making assumptions about the cash flows, but assumptions that they will ever have cash flows. That's the important differentiator. Or you're investing in an asset, for example, like Overstock, that it's not specifically for the core business. And therefore, by that notion alone, it has to fall for me into a speculative asset, right? Or if there's something outside of their control that dictates their business. So there's a microcap in my portfolio. I've discussed it before. The reason why they will always be speculative is because their core business was outside of their control. And so they can never make it into a core position. And then that keeps the risk lower, right? But it allows you to participate in things that you think could work out. And that's the emphasis. Could Robinhood work out? Perhaps. How do you know that it will? And then answer that question, and then be honest with yourself. What do you think are the probabilities that it will work out? And if we're being honest, we don't know. So therefore, for me, it would go into speculative bucket right away. Okay. Then the position, you don't want to make it so small so that if it does work out, you're not going to feel it. Like, for example, you put 0.00001% of your portfolio into that speculative company. You're not going to feel that if it 10x's. Okay. But if you had 1%, well, 1% drawdown, you won't feel that. That's a day-to-day motion. But 10x from that would go up to about, let's say everything else stays the same, around 10% of your portfolio, you would feel that, right? But, you don't want to be too greedy. So if you could go 50%, but that'd be terrible. That's terrible asset allocation. Okay. So with that being said, you want to hedge, or not hedge, but mitigate the drawdowns. Remember, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. Capital preservation should be your priority, not simply to grow and grow and grow and grow. Primary is capital preservation. You don't want to walk 1 step forward, 2 steps back. That's terrible. This is terrible for your financial well-being. All right. On that note, guys, if you guys have any other requests, leave them down below. They could be stock requests, or they could be industry level requests, or they could be conceptual requests. I'm doing all those videos. So I'm trying to do 1 video a day. There'll be some days where there's, like a gap, but 1 video a day of stock requests. And then, included in the same day will be maybe a conceptual video or an industry level analysis, and those will be separate. And then I'll also do more videos on stocks that I'm buying, and those will be separate from the stock requests, because those are ones that I'll focus on. Again, the Unilever that was going to be filmed and come out soon was going to be one that I was buying, but now it's going to be filmed differently as a introduction to the business, because now I can't say that I'm going to be buying anymore. I'm probably going to sell it here, but yeah. All right, guys, I hope you guys have a good one. If you guys like content like this, or you guys know someone who's interested in Robinhood, go ahead and send them this video, and they can give them hopefully a different perspective and hopefully help them on their investment journey. Other than that, thank you guys for watching. Bye.